The 2026 Roth IRA rules from the IRS have incredibly strict requirements when it comes to retirement savings, and making a single mistake can cost you thousands in penalties. From changing contribution caps to early withdrawal traps to hidden 5-year clocks most people don't even know exist, this is the complete guide to every rule, limit, and legal loophole you need to know for 2026. The Roth IRA stands as one of the most powerful retirement account tools ever created by the United States government. To understand why it exists, you need to go back to 1989, when two Republican senators, Bob Packwood and William Roth, proposed something radical. They called it the IRA Plus. The idea was simple but revolutionary. What if Americans could contribute money they'd already paid taxes on, and in return, every single dollar of growth would be theirs, completely tax-free, forever? Congress didn't bite. Not yet. It took 8 more years, but in 1997, the Taxpayer Relief Act finally brought the concept to life. They named it the Roth IRA after Senator William V. Roth Jr. of Delaware. Former Delaware Governor Pete DuPont later said of Roth, "We're all beneficiaries of the Roth IRA." He wasn't exaggerating. Since 1998, when the first Roth IRA accounts opened, this single retirement vehicle has quietly reshaped how millions of Americans build wealth. Here's how it works at the most fundamental level. A Roth IRA gets funded with after-tax dollars. You don't get a tax break today. Instead, your money grows tax-free, and when you withdraw it in retirement, you owe nothing, not a dime. That's the deal. Pay now, benefit later. This is what financial experts call tax diversification, having both pre-tax and after-tax retirement savings to manage your future tax liability. But there are rules, a lot of them. Let's start with the Roth IRA contribution limits for 2026. On November 13, 2025, the IRS announced that the standard contribution limit would rise to $7,500, up $500 from the previous year. If you're 50 or older, you can contribute $8,600 thanks to the catch-up provision. For married couples, that means you could put away $15,000 combined, or $17,200 if both spouses are over 50. And here's something many people miss. Even if one spouse doesn't work, they can still contribute through what's called a spousal IRA, as long as the working spouse earns enough to cover both contributions. There's no age limit on contributions anymore. That changed in 2020. As long as you have earned income, you can contribute whether you're 22 or 82. But income limits, those are very real. For single filers in 2026, the Roth IRA income limits phase out between $153,000 and $168,000. Earn above that range and you cannot contribute directly. For married couples filing jointly, the phase-out runs from $242,000 to $252,000. And if you're married filing separately, the phase-out sits stubbornly between $0 and $10,000. That's not a typo. The IRS essentially discourages this filing status for Roth contributors. Exceed the contribution limit and you'll face a 6% penalty on the excess amount for every year it stays in the account. That penalty compounds quietly, and it catches more people than you'd think. Now let's talk about withdrawing money from a Roth IRA, because this is where the rules get intricate. Your contributions, the money you personally put in, can come out at any time. No taxes, no penalties. That money was already taxed before it went in, so the IRS has no further claim to it. Earnings tell a different story. To withdraw earnings completely tax-free, you need to meet 2 conditions. First, your account must have been open for at least 5 years. Second, you must be at least 59.5 years old. Miss either requirement, and you're looking at income taxes plus a 10% early withdrawal penalty. There are exceptions. You can pull out up to $10,000 for a first-time home purchase. You can use funds for qualified education expenses, adoption or birth costs, medical bills exceeding 7.5% of your adjusted gross income, or expenses following a federally declared disaster. And here's a detail most people overlook. Withdrawals follow a specific order. Contributions come out first, then conversions, then earnings last. This ordering system actually protects you because you'll exhaust your penalty-free money before ever touching the taxable portion. Which brings us to the 5-year rule, and this is where things get genuinely tricky because there are actually two of them. The first 5-year clock applies to earnings. It starts on January 1st of the tax year you make your first ever Roth IRA contribution. Not the date you contributed, but January 1st of that tax year. So if you make a contribution in April 2026, but designate it for the 2025 tax year, your clock started January 1st, 2025. You could technically satisfy the rule in just over 4 years. The second 5-year clock applies to conversions. Each Roth conversion starts its own independent 5-year countdown. If you convert money at age 53, you need to wait 5 years or until 59 and a half, whichever comes first, before withdrawing that converted amount penalty-free. This creates what early retirement enthusiasts call a Roth conversion ladder, a strategy for accessing retirement funds before traditional retirement age. Now, let's get to the strategies that high-income earners use to get money into a Roth despite the income limits. The backdoor Roth IRA has existed since 2010, when Congress eliminated income limits on Roth conversions. The process is straightforward. You contribute to a traditional IRA, which has no income limit for non-deductible contributions, and then you convert that money to a Roth. There have been repeated legislative attempts to shut this strategy down, but as of 2026, it remains perfectly legal. There's one major trap, though: the pro rata rule. If you have existing pre-tax money in any traditional IRA, the IRS won't let you convert just the after-tax portion. If you have $50,000 in pre-tax funds and contribute $7,500 in non-deductible dollars, only about 13% of your conversion gets treated as after-tax. The rest becomes taxable income. The solution? Roll your pre-tax IRA money into a 401k before converting, leaving only after-tax dollars in the traditional IRA. And if your employer offers a Roth 401k option, that's another powerful tool for high earners to build tax-free retirement savings alongside the backdoor Roth strategy. Then there's the mega backdoor Roth, which operates on an entirely different scale. If your employer's 401k plan allows after-tax contributions beyond the standard limit, you can contribute up to $72,000 total in 2026. Then convert the after-tax portion to a Roth. That's potentially $47,500 flowing into Roth accounts in a single year, far beyond normal contribution limits. The newest strategy comes from the Secure 2.0 Act. Starting January 1st, 2024, you can roll funds from a 529 college savings plan into a Roth IRA for the plan's beneficiary. The lifetime cap is $35,000 subject to annual contribution limits. The 529 must have been open for at least 15 years, and the funds must come from contributions made at least 5 years before the transfer. One more tool worth knowing: the Saver's Credit. If your income falls below certain thresholds, $40,250 for single filers, $80,500 for joint filers in 2026, you can claim a tax credit worth up to 50% of your first $2,000 in retirement contributions. This credit disappears after 2026, replaced by the Savers Match in 2027, where the government will directly deposit matching funds into your retirement account. Not everyone loves the Roth IRA, by the way. Economist Leonard Berman, co-founder of the Tax Policy Center, warned that the government is bringing in more now, but giving up much more in the future. His analysis projected the Treasury would lose $14 billion in revenue over several decades from Roth-related provisions alone. But for the individual saver, the math is hard to argue with. Tax-free growth, no required minimum distributions ever, the ability to pass the account to heirs, and a contribution deadline that stretches all the way to April 15th of the following year. The Roth IRA isn't just a retirement account. It's a 50-year tax strategy disguised as one. Learn the rules and it works for you. Ignore them and the penalties will remind you why they exist.